All right, let's look at that data there for the way in which we are consuming debt in the country, and you're going to confirm from all the data sets that we're giving you here this morning. Everything is just on the increase. Kenya's outstanding debt to China on the increase. We're going to see our public debt as well. It's on the increase, but that year-on-year change, we already spoke about it last week, that despite it declining, then our interest repayments are the ones that are making that debt to China increase. Kenya's public debt has also been on an increase, standing at 7.7 trillion currently. Let's cross over then and talk about the next one. Kenya's external debt has also been on an increase, and China accounts for 70% of that external debt. Now you see where we are in terms of that domestic debt. All right, let's talk about those figures this morning. Let me begin with you, George. Is this a crisis? But then when you look at the recent rebase, does it sort of lessen that crisis?
Elijah, we have talked about this since I think 2018.
Yes.
That the rate at which our debt portfolio is growing is not sustainable, Elijah. And if you look at our debt, all our metrics in terms of debt to GDP ratio, the percentage of revenues that we used to pay our debt, our debt ratio vis-a-vis our compatriots, then we are trending on a debt distress space, and that has been confirmed by the IMF. Elijah, remember, Kenya has rebased its economy, I think twice since 2013, and the reason for rebasing that economy is so that we can raise our GDP, our nominal GDP to a certain level, so that our debt to GDP ratio is still within comfortable limits. But if you look at the fundamentals that our rebasing are based on, then they're purely what we call paperwork. Nothing you can lay your hands on. If our GDP had not been rebased, Elijah, then our debt to GDP ratio would be somewhere approaching 70%, which is quite high given our economic model. There are some economies that can absorb such high debt to GDP ratio. Economies like China, economies like the US can absorb that because of the levels of revenues that they generate on a day-to-day basis. But ours might not be able to accommodate that. With the rebased GDP, our debt to GDP ratio is currently at, I think, around 55-56%.
Yes.
But that is nominal. That is not what we actually have. And remember, the way we classify our debt, Elijah, I think IMF had a problem with the way we classify our debt because we only consider what we call the national debt, national real absolute debt, and that is what we calibrate as our total debt portfolio. We don't consider our guarantees that we've given to corporate parastatals. We don't consider other intrinsic debts that the government might have. And if that was considered, then our metrics will go quite high. And therefore, Elijah, even if you look at the figures as they are, if you are paying close to 65% of your revenues towards loan, then you remain with a paltry, I think, 36% to cover your recurrent expenditure and even your development expenditure. That is not sustainable because with the 36%, you might not be able to even cover your recurrent expenditure. That's why sometimes you find the government borrowing, and they call it budgetary support. What government means by budgetary support is that those funds are going towards funding our recurrent expenditure. What that means, Elijah, is that we are borrowing money to fund our day-to-day operations in the economy, which is not sustainable. And I dare say, Elijah, that if you don't find a different trajectory in the way we manage our debt, then sooner or later, Elijah, we might find ourselves where Greece found itself, where so many other African countries have found themselves. Remember what happened to Zambia the other time, when China was forced to take some of its key establishments. I think maybe that is where we might be headed to if we don't take drastic actions now. Elijah, in the previous financial year, the Kenya Revenue Authority surpassed its target. And when the taxman surpasses its target, then you expect that to flow back to the economy. But you're seeing very little changes in the economy. Meaning, a bulk of that money that was collected by the taxman went into debt repayment.
Yes.
And that might be the case in the next 2, 3, 4, or even 5 years. We might reach a point, Elijah, where we don't have for development. And if you do that, then your GDP starts going down, because a country's GDP only grows when government invests in development projects or development expenditure. It doesn't grow when you're just doing recurrent expenditures. And the way we are going, Elijah, I bet you that IMF or World Bank might come back to us with what we call the structural adjustment programs that we had in the 90s. And that would be a very sorry state of affairs if we were to reach there. So in my opinion, Elijah, we must tackle this head on. I know most government functionaries know what's happening, but I think they don't want to tackle it because of ramifications. And I think that is something that the incoming government, or even the government that is there today, should tackle head on. They should not mind about the political ramifications of it, because eventually we will be forced to do that at a certain point. We are better off swallowing the pill now, when it is still much easier, than waiting until we reach a dead end, and then now we must deal with it at that point, Elijah.
Yes. All right, Odhiambo Ramogi, come in with your sentiments as well, and I want us to begin from here. That 66% of our ordinary revenues go into debt repayment, and that is a jump from what we were in 2019-2020 of 44%. Number two, we are borrowing in the domestic market to repay external debt, which is exactly why banks actually lending to the government did jump by 50% and at 2020 crossing over to 2021. Is that where it is? Is this the only number they should be looking at and then saying, no, things are bad?
No, things are bad. No, first of all, I'm actually surprised George is putting the debt to GDP in the 50s. It's actually in the 70s. By my calculation, around 71%. And government nowadays don't press, because before they used to, half of government used to say one figure, the other half says another figure. So you actually have to come to the CB confirm that, go to the economic survey and see what's the GDP, and you see which of the two is saying the truth.
Yes.
When you do that, it's to 7%, because the debt burden as at now is 7.7 trillion. Our economy is at 10.75 trillion. Yes, there was a rebasing. That rebasing only added government an extra $500 million. Before that, we were at 10,250. The economy contracted briefly, but it increased to 10,750 because of the rebasing. So now 7.7 over 750 gives you 71%, which means that of the wealth we have as a country, 71% is actually owed to other people. The principle in this is the likes of the Chinese. But now, even in terms of the control budget is saying that 4 to 6% goes towards reducing this debt. I agree with her that we need to do something about it. I think the institutions are waking up to the reality that they are doing, that no one else is going to do this if they don't. And so I saw the state governor that day can foul the debt levels are unsustainable. I have seen now the controller of budget is complaining about it. Of course, it's a bit late in the day because we are at a very bad place, but it's not too late. It's late, yes, but it's not too late. This is what happens when Treasury is not providing the leadership that it's supposed to provide. Then institutions are forced to make noise for there to be a semblance of a policy direction. And so, yes, I agree with her that we need to restructure our debt. We've been saying this for a very long time. I don't think it's just from 2018, George. I think we've started this conversation earlier, especially when these guys got to power and they got excited, and then Eurobond 1 and SGR came on board. At that time, we were already worried that the debt levels were unsustainable. So I agree there is need to restructure the debt, and it should begin by some of these debts we are seeing on brick and mortar investment. We are not really investing in human development, and that should be prioritized.
Pretty much. George, just briefly then, make us understand the impact of borrowing domestically to pay external debt. Looks like there's a disconnect there. What can lead to this, George? And what is the likelihood, or what is the expected impact locally on us trading the Kenyan shilling for the dollar?
And I remember last year, I think we defaulted on, I think, one or two of our facilities. I think one of them was the French that we had.
Yes.
And I think another Chinese loan we were not able to pay up. And I think already those facilities were restructured so that we only pay the interest element. And when that happens, Elijah, then your credit rating internationally dampens. And that if you look at our Moody's rating, I think in 2016, 2017, and look at our Moody's rating today, our rating has gone down. What happens when your rating goes down, Elijah, is that you are only able to secure credit at quite expensive, because now the lenders must capture that risk premium that you might default on your loans.
Yes.
When that happens, Elijah, then the government finds itself in the catch-22 that it has to pay certain loans to be able to access other credit facilities. It has to maybe to be able to open a tap loan in another jurisdiction. And that is why you find government sometimes coming back to the domestic market to be able to raise money, to pay specific facility for them to be able to raise money in another jurisdiction. When that happens, Elijah, it brings you to, now trying to compete with the private sector for the domestic facilities. Remember, most private practitioners or most private companies would raise money off, but government is able to. So when government not raise money offshore and they come back to the domestic market for credit, they what we call crowding out the private sector from the local credit market. If you go to a lender today, you as a private company and government, of course, the lender would want to focus on the government first before they come to you, because government is a risk-free percent. So what government is doing by borrowing locally is to crowd out private sector. Remember, the private sector is the economic drivers or the economic enablers of an economy like ours. And when you do that, then you dampen what we call the real GDP growth in your jurisdiction or in your economy. Remember, the previous regime, the biggest economic model was to leave local market for the private companies and borrow offshore if they were to borrow. And that worked quite well, Elijah. And credit was easily accessible to the SMEs, to the private companies. And that spurred our economic growth. I think we hit around 7-8% during the last regime. But if government was to borrow locally, then the local companies will raise money to finance the economic activities, and that will dampen our GDP growth even further. So to go back to Treasury and just advise them that they just need to restructure the debt portfolio. They might want to freeze maybe development the next 1 or 2 years, just to restructure the debt portfolio.
Yes.
But trying to do some of these things is like taking paracetamol to treat cancer, which doesn't work at the end of the day. It just brings down the pain, but the ailment is still there, Elijah.
Pretty much. Gentlemen, let's move on to the last issue this morning, where the general economic indicators such as corporate earnings, imports and exports, and the private sector activity in 2021 are the ones that seemingly stopped the Central Bank of Kenya from rolling out fiscal policies despite a 0.3% contraction in the growth of the economy in 2020. Economic analysts in the country believe that the economy is on a recovery path, which is a deep contrast from last year, in which top sectors in the country were impacted on negatively by the pandemic. Normally, the regulator would look to roll out monetary easing measures to stimulate the economy after a contraction. And at 2020, the CBK intervened by cutting on the base rate to 7% from 8.25% and lowering the cash reserve ratio CRR for commercial banks to 4.25% from 5.25% to free up liquidity for lending to the other sector. Other interventions also came in the form of temporary removal of fee on mobile transfers of a value of below 1,000 and banks moratoriums on a loan servicing as well. Odhiambo Ramogi, what are some of the indicators really that the country is on an economic recovery path in 2021, and should the CBK have ruled out other monetary interventions once they realized that the economy had contracted by 0.3% in 2020?
Let me start with the latter. I think, because I think it's an easier question. The indicators are, that's a qualitative question.
Yes.
Yes, I think there was need to move cautiously in the market last year. One, we didn't have precedence of this except in the early 1900s. And so the economy at that time was very different. Kenyan economy really was, you couldn't describe it, so there was very little to learn from.
Yes.
And so when that happens, what you do is you try to maintain the status quo so that you only make decisions when you have sufficient data, and this data takes time to collect and to make sense of. And so on that one, I think I agree with CBK. There was need to move cautiously. There was needed to just wait on it until we are sure of what is happening. And you remember, central banks are usually very conservative. Before they make any monetary moves, they take a while. And ours has been sober in a very weird treasury, if I can put it that way. Now, as to what are the indicators of growth this year, I think there is people are back to work, and for me that is in itself a real qualitative indicator that yes, we are back to work. There is some economic activity happening, but the second one also is there's a lot of opportunities opening up, job opportunities that previously were not there. On the contrary, while companies and businesses were laying off last year, this year, on the contrary, they are looking for staff. They are looking for people. You can see and feel expansion of these businesses. Beyond this, also, you can see there's trade that is going on. The supply chain global supply chain was affected last year, and some of the trade was not going on. I remember getting some beautiful big avocados for 20 bob. I shouldn't have said this on air.
You've committed an economic crime.
Because previously you'd only get those ones at 100 or more because they are going for the international markets. There was no international market. We were the only market they had. Now, of course, we are back to normal, and the prices of avocado are high. Essentially, yes, you can see there's a lot of activity, and there's money supply.
Yes.
Even when you look at the reports, I think there's impressive indication that our economy is upward looking.
Pretty much. All right. George, in just 2 minutes, if you can you clear this conversation this morning? I would like to pick it up from that once you go through a contraction, then you're expected to react with some sort of a monetary interventions from the CBK, but they did not do it this time. Did the economy deserve an intervention from the CBK, or indeed things are back up and running in 2021?
I've said here again that Kenya is a resilient economy.
Yes.
If you look at our GDP growth or contraction of that matter in 2021, I think we contracted by 0.3%. Most economies in Africa contracted by between 2 to 3%. The only economy that grew was Tanzania, which grew by 1%. Of course, that was understandable because then they didn't take any COVID measures, so to speak. So if you look at our economy vis-a-vis our peers and even the bigger economies, then you realize that we are quite a resilient economy. But getting out of a depression, Elijah, that we've experienced before, requires a lot of thought process, a lot of intervention from Treasury and from even the planning department, the economic planning department, and from the Central Bank of Kenya. If you are to go out of this, Elijah, then we need to get some very clear interventionary measures into the economy, which unfortunately, Elijah, we are yet to see. In such a model, Elijah, most economies would pump quite some money into the market. Remember what US did the other day by pumping quite a lot of dollars into the market to spur economic growth into that market. The Federal Bank of the US pumped quite some huge amounts of dollars into the market, and that is what we'd expect to see in our local context. Of course, Central Bank would want to monitor the inflationary pressures if they were to do that. But so far, I think they have maintained their inflationary levels to below 5%, so to speak, which is a good thing. So I think this is a time that government needs to come out very strongly and put in intervention measures that will see our economy back on track. And as William has said, I think most companies have gotten back to business, albeit with a bit of caution in maintaining the COVID-19 protocols as they should be. But if you look at our economy across board, then you realize agriculture is back to normal. Logistics is back. Tourism is struggling, but it's coming back. Manufacturing is coming back. So this is the time that government needs to support some of these enterprises so that they not only get back to where they were, but even surpass the economic activity by the time COVID-19 hit us. Remember, Elijah, that COVID-19 hit when we already struggling economy. Our economy was not doing very well when COVID-19 struck. I think we were doing 5% GDP growth, of which initially we were doing between 7 and 8%. So I think we need to do much to get back to not only where we were in 2019, but even surpass that. Our economy, Elijah, in our context, should be growing by between 7 to 10%.
Yes.
If we were to reach our SDG goals or our Vision 2030 goals. So government has a lot to play in this space, and they have to put the act together if they're to get this economy back to where it was. Remember, we lost over 700,000 jobs, and that is what was reported. There are several jobs that were lost in the economy that have not been reported. If we are to get this person back to work and even more, then we have to do more than what we're doing currently, Elijah.
Pretty much. At this time, I'd like to say thank you very much to you, George, and Odhiambo Ramogi, for taking your time off your busy schedules to speak to us here at Metropole Television. We really appreciate it.
Asante.
All right. On that note, fantastic. On that note, we come to the end of Business AM. You can take them back to the time that they came to the studio, speaking matters economy at Metropole TV KE across your social media platforms on YouTube, Metropole TV Kenya. Good morning.